I would like to welcome all the AR13 students to this first class. Our lesson for today is 10.3, Macroeconomics. Our strand outcome, investigate how an economy operates and functions to achieve its economic growth. Our content learning outcome, explore the effects of money supply in the economy. And our learning outcome, at the end of the lesson, students should be able to identify and explain the factors that cause primary expansion in money supply. Our lesson 1, the primary factors affecting money supply. As we know, today it is money is a result of long process and have evolved over time. In our modern time or modern era, money plays an important role in the primary function of being a medium of exchange. You know, money is a medium of exchange. We exchange goods with money. The latest type of money is a plastic money where cards are used. That is the debit cards and credit cards. We have debit cards and credit cards. It is convenient to use the cards rather than a large amount of money we carry in our pockets. This aim is to remove the need of carrying cash to make transactions. Card is convenient. Cards are convenient and easy to carry. You don't have to carry large amount of money. It is also not safe to carry large amount of money in your pockets. And next, the money supply consists of notes and coins in the hands of the public plus the demand deposit with the bank. So all the money supply we have consists of notes and coins in the hands of the public. Public is you and I, and all the money that is withheld in the bank. Money supply is also categorized in three. It is M1, M2, and M3. Money supply changes due to two factors: primary expansion of money supply, and we also have the secondary expansion of money supply. We'll be focusing today mainly on primary expansion of money supply, and later lesson we'll be looking at secondary expansion. But for today's class, we'll be only focusing on primary expansion of money supply. Primary expansion of money supply in primary expense changes money supply is a result of new deposits being deposited in the banking system. All the money that is deposited in the bank will have the primary expansion in the money supply. Such new deposit has effect on increasing the reserve of banks. So if you have new deposit, it will also going to affect the increasing of reserve in the banks, which means the reserve will be greater. Then those are required to support the existing level of customers' deposit. Therefore, banks can lend out more money. If there are more money deposited, more reserves in the bank, banks can also lend out more money. There are several factors which cause primary expansion of money supply, and they are these are government borrowings, that public debt policy. We also have the foreign aid, remittance, export earning and import payments, open market operation, interest rate, and moral situation. We are going to explain all this in detail. Now we'll start with moving on the effects of primary factors on money supply. Each primary factor has effect on volume of money supply. These effects are first, we will be looking at the government budgetary transaction, whereby the government national budget spending has effects on money supply. This happens, you know, there are three types of budget we have: budget deficit, balanced budget, and surplus budget. Now we'll be looking at the budget deficit, how is going to affect the money supply. That is, when government has a deficit budget, which means there are a lot of money has been injected in the economy, or there are a lot of spending. So government don't have enough money, and this how government is going to finance the deficit budget. That is borrowing from the Reserve Bank. Government is going to borrow from the Reserve Bank. This simply means printing more money. Government is going to print. Government is directing the Reserve Bank to print more money. That is to finance the budget deficit. And this means when the more money is being printed, money will be injected in the economy, money supply will increase. Borrowing from overseas under floating exchange rate, if there is if any money is borrowed from overseas, that is going to be through exchange rates, right? Our country has different exchange rate. Different countries have different exchange rates. For example, if Fiji is going to borrow from New Zealand, Australia, exchange rate will differ, and this is going to increase in money supply. Borrowing from the private sector, government is also going to borrow from the private sector, that is from the public, by selling bonds and securities, will lead to transfer of funds from private sector to the public sector. If government borrows money from the private sector or is going to sell bonds, this is going to transfer funds from the public sector from the private sector to the public sector. And this is going to increase the money supply. It's also going to lead in crowding out of investment. However, money supply will remain unchanged. Now we'll be looking at budget surplus of the government budgets. Like I have said, there are three types of budget. We have already discussed about the budget deficit. The next budget is the budget surplus we are going to focus on. The government budget for a surplus means that there is more withdrawals of money from the economy. The government is not spending. It is just holding on the reserves and not spending. The domestic money supply will fall, because when there is a budget surplus, which means the people have to pay a lot of taxes to the government. And taxes in form of collection, there is no spending, which means this is because the volume of money will be withdrawn from the economy. A lot of money will be withdrawn from the economy, and there will be a volume of money, and there will be no money injected in the form of government spending. Government is not spending. It is called budget surplus, and there will be a lot of revenue for the government. There is no spending. Therefore, there will be a budget surplus. And if this happens, there will be the budget surplus contracts the economy. Contracts the economy means our GDP will be affecting, right? There will be no investment in the economy because our budget contracts, and there will also be high rate of unemployment will result from that budget surplus. High rate of unemployment, inflation will occur. A lot of things will happen. There will be the economy will not be in unrest. Foreign aid is very simple. As you know, the inflow of money in the economy from overseas, like what we have experienced in this COVID-19, a lot of money from overseas is coming from Fiji, from overseas countries. They are helping out. Australia and New Zealand, for example. We also have United States, the other countries which are helping. The international transfer of capital, goods or services from country, or internationalization from benefit to a recipient country. They are helping. For example, Fiji, if you look at our situation in Fiji, during COVID-19, a lot of people don't have jobs. People don't have, people are starving. People have causing a lot of problem here in Fiji. So the foreign aids, government are receiving foreign aids to help out these people. Increase in foreign aid to a recipient country will increase money supply, and vice versa. Like if government receives the foreign aids, it will not keep it in their reserve. They will give it out to the people, give it out to the public. They are injecting money in the economy. As if, for example, the $50 payout to all the people who are not working. Example, the students are also getting $50 over 18 years of age. All the students and the public who are not working, people who are not working, they are receiving. This is one example I'm telling you. This is the foreign aid where government is receiving money from. Is an inflow of money in the economy. So it is going to increase the money supply in the economy, because a lot of money is coming in, goods are coming in, services are provided, right? The people are coming to help out our countries during times of crisis. Remittance, transfer of money from a migrant worker to their families or other individuals in their home countries. As you know, remittance is some people are working overseas. Our families and friends are working. Our fathers and maybe our close family members are working in overseas countries. They're sending money home to the home country to help out their families. For example, the soldiers are working for peacekeeping. This money is being transferred from overseas to their home country, and this the money is coming in. Is going to increase the money supply. This is an inflow of money. Example, if you look at some of the the expatriates are working here in our country, in Fiji, from India and other countries. They are sending money to their home country to help out their families, and this is going to increase. This remittance consists a significant portion of GDP. Is also going to increase our GDP because people have money. People, when the people from overseas are helping their families in the home country, and increase in remittance will increase money supply. They're going to increase in money supply because the money is coming in our country. That's the inflow of money in our country is going to increase money supply and vice versa. The next one will be looking at export earnings and imports payments. Export earnings, right? Most of you know what is export. First of all, you have to understand what is export. Export is when you are selling goods to overseas. In return, we get money. Increase in export earnings will increase money supply. If you export a lot of goods, money will be coming in our country. Lot of money will be coming in the country through our export earnings. And the other hand, increase in import payment will decrease money supply. If we have lot of import, we are buying goods every day from overseas, like every time now and then we are buying, we are importing. There will be outflow of money from our country. That is, money is going out. To avoid this outflow of money in the economy, you want to have our increase in money supply. We have to cater for that import substitution. That term import substitution means we have to produce goods in our own country, like with our climatic conditions we have. For example, the latest is planting of potatoes and sheep shearing. We are also producing sheep here. So all those things like which are imported for overseas, now we can have it here in Fiji. That is called import substitution. And we don't have to pay a lot of money to overseas countries. The government is encouraging to have a Fiji-made goods and services. That is called import substitution. Which goods we are importing, we have to produce in our own countries. And this is, if you are doing that, that is going to increase our money supply. You don't have to pay a lot of import payments. And the other thing is the open market operations. Like I've said, open market operation with OMO is this is not a OMO powder using, that is the open market operations. When the Reserve Bank sells the government bonds and securities to the public, it is selling and buying of government bonds and securities to the public. That is, if the government is selling the bonds to the public, that is, the account balance, the public account balance reduces, going to decrease, because the public is going to pay for the bonds and stocks. That is going to decrease in account balance and decrease in reserves. Hence, the money supply will decrease. Money supply will also decrease because the public is paying. So the money is going out of the country. It is withdrawal of money from the economy. So government is selling, money is going to the government now, and that is going to withdrawal of money from the economy, and hence the money supply will decrease. Whereas when government buys bonds and the Reserve Bank buys bonds and securities, the public account balance increases, hence increase in money supply. When Reserve Bank buys, okay, the bonds will be going to the Reserve Bank, the money is injecting in the buys means this money public is buying, right? So bonds and securities, so the money is coming in the country, injecting in the economy, it will going to increase the money supply. That is called open market operation, selling and buying of government bond and stock into the public. Interest rates are very, very important factor for increase and decrease in money supply. So if there is a increase in the interest rate, leads to decrease in investment. With a very high interest rate, people don't want to invest. The purpose of investment is to get the return. If there is a high rate of interest, for example, the interest rate has increased from 10% to 15%, people will not borrow money for investment. Thus, aggregate, the demand for the money will decrease. People will not borrow for investment, the demand for the money will decrease, hence the money supply will decrease. When there is no demand for the money, there will be a decrease in money supply. Because of the high interest rate, people are not want to borrow, they don't want to invest. When decrease in the interest rate lead to increase investment, when interest rate decrease, everybody is running to the banks for investment. They want to invest because of our interest rate is very low. People will get the money, and they're anticipating that they are going to have a high rate of return. So interest rate plays an important role for investment. If there is high rate of interest rate, there is no investment because people not borrow. The aggregate money supply decrease and money aggregate demand decreases. Therefore, the money supply will decrease, and vice versa, where there is an increase in interest rate lead to increase in investment. Right? If there is a decrease in investment, there will be increase in investment. It will run opposite. Right? Decrease in investment, decrease in interest rate, increase in investment. If there is increase in interest rate, there will be increase in the increase in investment. If there is a decrease in interest rate, increase in investment. It is inversely rated of the direction. One increase, the other one will decrease. The other will increase, the other one will be decrease. And if there is a decrease in interest rate, lead to increase investment. With lower interest rate, people will want to invest more, and thus aggregate demand will increase. The money will demand for the money will increase, and hence the increase in money supply will also increase. Moral situation is a non-official tool of monetary policy, which is government employ to persuade financial institutions in following suggested guidelines on the ability and cost of borrowing. It is a guideline. It's a non-official monetary tool set by the government. This is to convince the financial institutions, and this is the suggested guidelines on the ability and the cost of credit. Cost of credit is the interest rate. Moral situation is used typically by making policy announcement. It is the policy announcement they are used, making policy announcements to induce the desired response before resorting the mandatory compliance through statutory regulations. Therefore, the moral situation, money supply is increased. Thank you, students. We have some of the questions I have put in. It is for you to review, and this is for you to conclude yourself, just to review yourself how much you have learned. These are a set of questions. You can do it and see how much you have learned. Thank you for watching. Stay safe and abide by all COVID-19 protocols. If you have any question on today's lesson, feel free to ask through Year 13 Economic Fiber Group. Vinaka.